if we do have an economic collapse, it's important to think through what happens next. If things go from bad to worse, and I don't think that's going to happen, but I think we're smart to plan for it in case it does. So in today's video, I want to share with you my views on what comes after an economic collapse. And this isn't the first time the country, the United States, has seen an economic collapse. And I'm not saying it's going to happen, but we certainly saw that during the great financial crisis. I would argue that we saw it during the dot-com bubble burst, and we saw it in the first month or two of COVID, when the pandemic was declared, when the S&P 500 dropped over 30% in under 4 weeks, in under 20 trading days. It was the quickest drop ever for the U.S. stock market in history. It was a more severe and more quick drop than we saw during the Great Depression. And when I say by more severe, I mean it just happened more rapidly. The loss during the Great Depression was more, but not so quickly. To lose 30% in 4 weeks I would have thought unthinkable. But we have to plan for the unthinkable, which is what today's video is about. So what do we do? The first thing is we look at what are the things that will protect us if the unthinkable happens, if something bad happens. And I would argue the first thing and the most important thing we have to protect ourselves is our asset allocation. And the time to think about asset allocation is not in the heat of the moment. It's not when the waves are, crashing over the bow of the ship and we're terrified for our lives. And frankly, I felt that way in the initial days of COVID. That was not a time for anybody to be making important decisions. The time for making important decisions, frankly, is a time like now. Yes, as I record this, the S&P 500 is down about 10% from its February 19th high. But we're still thinking it rationally. People are talking about buying the dip. People are calm. Where I see things go from calm and talking about buying the dip is when we get closer to 20%, 25% correction in the stock market. So the time to think about that is now. Now, it wasn't that long ago that the market was posting all-time highs. In fact, at the start of the year, the market was posting or near all-time highs and continued to go up until February 19th. So it hasn't been that long on this 10% correction. But the time to think about that is now. And if we look back just a little bit further, from October of 2022 to October of 2024, that was the low during the 2022 pullback. To at the time, the high in 2024, over that 2-year period, the S&P 500 was up 60%. That's a big, big move. So this is not financial advice, but I do encourage you to think about looking at your asset allocation. Is your asset allocation right for you? Because the time to make those adjustments is when we're thinking clearly, when we've gotten a good night's sleep for the last 2-3 months. It's not when we've been tossing and turning and worrying has amplified to angst. And now we've gone 4 days, 4 weeks without a good night's sleep, and it's hard to make a good decision when you're in that point of view. So that's number one. The next one is thinking about how would you avoid being a forced seller in a down market? And typically people become forced sellers in a down market by a couple things. One, they need the cash, either to live on, or sometimes people are real estate developers. I know not many of my viewers are real estate developers, but just a quick funny side note. Real estate developer attorneys, so the attorneys that have clients that are real estate developers, tend to have 2 areas of specialty. Not all of them, but it's not uncommon for somebody that specializes in helping real estate developers to also have expertise in, guess what? Bankruptcy. And the reason is because real estate tends to go in cycles. Now, fortunately for real estate developers, the cycles are pretty long, but it's kind of musical chairs. If you get over leveraged at the right time, you can make a lot of money. But if you get over leveraged at the wrong time in this game of musical chairs, you can find yourself the one without a chair. You can find yourself the one declaring bankruptcy, which is why some real estate attorneys have that second specialty so that they can weather the storm as well, and they have work even when their real estate developers are not closing new deals. So avoid being a forced seller in a down market. I talked about people that have debt that need to pay off that debt and they have no other source of liquidity, so they have to sell stocks at a loss. Another more common one for us is we need it for our living expenses, right? Maybe we've retired, maybe we've lost our job, and we need our investment account to pay for our living expenses, which is why it's so important if you're still working to have an emergency fund and at least 3 months of living expenses, preferably 6 months. And I would argue, actually, as we get older, if you think to yourself, hey, if I got laid off next week, I would look for another job. I'd want to keep working. The reality is if you're in your 50s, if you're in your 60s, it can take quite a bit of time to find that next job. So you might want to have an emergency fund that's even larger. So again, what happens after the catastrophe? Again, we've seen catastrophes before. If we're prepared for them, we can weather them, just like all of us were able to weather the great financial crisis. Most of us weathered the dot-com. Most of us weathered COVID. But the idea is to plan ahead. So avoid being a forced seller is number 2. Number 3 is to have a plan. And to have a plan where you have thought through different contingencies. What happens if the market does really well, right? We don't want to be overly conservative because if we're wrong and the stock market does well, and it very well could, if the stock market does well, we don't want to leave all those chips on the table. Conversely, if the stock market goes from bad to worse, we also don't want to experience so much pain. We also don't want to be a forced seller in a down market. So finding that balance is important. And how do you find that balance? You find that balance by having a financial plan. You do that when you're thinking rationally. I like working with a financial advisor. I know not everybody in my audience is going to do that. If that's you, I urge you, instead of using Google Sheets, instead of using Excel where you can make a mistake, you can forget about something, you can point to the wrong cell, you can have the wrong formula in there. I urge you to spend money to use software that's designed to help you come up with a financial plan. The software I like is called Bolden. It used to be called New Retirement. People rave about it. They love it. If you use the link that's in the description of this video, you'll be supporting the channel. This video is not sponsored by Bolden, but I am an affiliate, so it's very affordable. It's about $120 a year as I record this, but a small piece of that goes to me and my channel if you want to support us. So the final thing I want to share is, just it helps to be able to mentally weather this storm, and it helps to think through things ahead of time. One of the things that I used to do occasionally with my clients is have them think about, okay, here's my account. Let's say it's worth $500,000. What does a 20% correction look like? And you put that in an envelope and I slide it across the table and say, last quarter, your statement said you had 500,000. Now you had 400,000. How does that feel? To do that simulation, to think through the pain of it. The idea is to make good decisions. If you like this video, the YouTube algorithm says this is the next video on mine on making good decisions that you should watch.